You know that feeling when the stock market starts doing like the cha-cha slide?
Yeah.
One step forward, two steps back.
Oh, yeah.
And those investments you thought were, safe, suddenly feel about as secure as a toddler on a sugar rush.
Huh. Yeah, that's a good way to put it.
Mm.
It's definitely unnerving for a lot of people right now.
Right. Makes you want to just stuff cash under the mattress.
Well, that unease is pretty common. The market swings make it really challenging sometimes to find, like, dependable returns.
So today we're digging into something that might help. Fortress dividends.
Fortress dividends, I like that term.
Yeah, think of these as companies kind of built to withstand storms, not just surviving, but actually keeping that reliable income flowing.
We're talking solid businesses, strong profits, models that aren't just going to disappear with the next trend.
Exactly. They've got those economic moats people talk about.
Right. The goal here isn't necessarily like explosive growth overnight.
Yeah.
It's more about consistent, dependable income, stuff you can hopefully count on whatever the economy's doing.
And so our mission, really, in this deep dive is to look closely at two specific examples from our sources.
Give you a clear picture.
Yeah, help you understand why companies like these might be worth a look if you're after that reliable income stream.
And these are, well-established names. They've seen a few economic cycles.
Definitely. We're talking Johnson & Johnson, ticker J&J, and AbbVie Inc., ticker ABBV.
The big players.
Grandma approved, apocalypse ready, dividend beasts, maybe. Let's start with Johnson & Johnson, J&J.
Okay, J&J. Yeah, the first thing that comes to mind is just consistency, reliability, like that unflappable khaki-wearing dad from the outline.
Huh. Yeah, totally. Just steady. And that feeling, it's backed by some serious financial muscle, right?
Absolutely. That AAA credit rating.
Which is huge.
It really is. I mean, how many U.S. companies have that?
Just one other one, right? Microsoft.
Exactly. It puts their debt safety basically on par with U.S. Treasury bonds. It tells you a lot.
Tells you they're exceptionally stable, can handle their obligations, even when things get rocky.
And beyond that, they churn out strong free cash flow consistently.
Which is like the cash left over after running the business and investing back into it.
Precisely. Give them loads of flexibility.
And they're not just a one-trick pony either. Their revenue is, well, it's really diverse.
Spread across different areas. Plus, they're everywhere. Huge global footprint. What is it, like 130,000 employees?
Yeah, over 130,000 in 60 countries. It's massive. But, okay, the core reason it's a fortress for income seekers. The dividend.
Yes, the dividend history. It's pretty remarkable.
62 consecutive years of increasing the dividend.
62 years. Just let that sink in.
That's incredible. Longer than I've been alive. Puts them squarely in, like, dividend royalty territory.
Definitely. And the payout ratio is important, too, isn't it? Around 45%.
Right. What is that number, that 45%, actually signal?
Well, it suggests they aren't straining to pay it. They're keeping a good chunk of earnings back, for growth, for a cushion.
So it means the dividend is sustainable.
Yeah, it suggests sustainability. They have room to keep raising it. Like the source said, JFK Airport levels of runway for more increases.
Okay, so what's driving this? It's not just luck. It's that diversification, right, across their different business parts.
Exactly. You've got three main segments. First, pharmaceuticals. That's prescription drugs. Big names people know like Cetara, Darzalex, Tremfya. Usually high-profit stuff.
Okay.
Second, medical devices. Think joint replacements, surgical tools, that kind of thing.
Right. And the third one is probably what most people touch every day. Consumer health.
Yeah, your Band-Aids, Listerine, Neutrogena, things people buy pretty regularly, good times or bad.
So how does having those three legs help them be resilient?
It acts like a buffer, really. If one area slows down, say people put off elective surgeries, hitting medical devices, but the other areas, like consumer health, can help pick up the slack. People still need bandages and mouthwash.
Makes sense. Now, we kind of have to mention the legal stuff, don't we? The talc powder lawsuits, that's been in the news.
True. It's a significant issue, no doubt about it.
So how does a company deal with something like that and still keep raising its dividend like clockwork?
Well, that's where their sheer financial strength comes in. The diversification, the massive cash flow, it lets them manage these major headwinds without necessarily derailing the core business, including the dividend.
The source put it pretty bluntly, like, we have lawyers on retainer for this exact reason.
Yeah, it kind of underscores their preparedness, their ability to handle these big challenges as part of doing business at that scale.
Okay, so wrapping up J&J, key takeaways seem to be dividend king status, that rock-solid AAA rating, diverse businesses in essential areas.
And just an unwavering commitment, it seems, to growing that dividend year after year, a real pillar of stability.
All right, let's switch gears then. AbbVie. ABBV.
Okay, AbbVie. A bit of a different vibe here, maybe. Less the steady dad, more the warhorse with swagger, as the source called it.
Yeah, I like that description. Spun out from Abbott Labs back in 2013.
Right, with a clear mission.
Mm-hmm.
Focus on drugs, sell them, and send cash back to shareholders via dividends. Pretty straightforward.
Then they really burst onto the scene with Humira, didn't they? The source called it a $20 billion juggernaut.
Yeah, that number is just massive. I mean, $20 billion a year, that's like the GDP of a small country almost. It was an engine for them for a long time.
But banking on one huge drug, that's risky, isn't it? Patents expire.
Hugely risky. And that's where AbbVie did something kind of impressive and maybe a bit unusual for pharma.
Which was?
They actually planned ahead, really proactively. They knew Humira wouldn't last forever, so they started building the next thing.
Okay, so what did they do? How did they prepare for life after Humira?
Well, they launched new drugs, Skyrizi and Rinvoq, especially in immunology, and those are doing really well. Big growth drivers now.
Right.
And they made that huge Allergan acquisition.
Ah, Allergan. That brought in Botox, right? And Juvederm.
Exactly. Added a whole aesthetic medicine piece, diversifying away from just traditional pharma. Plus, they're still investing heavily in R&D oncology, neuroscience.
So it wasn't just replacing Humira, it was broadening the base. The source called it fortress construction with reinforced steel.
Yeah, a good description. Building a wider, more stable foundation for revenue.
Okay, let's talk dividends for AbbVie, because that's a big part of the appeal too, right? The yield is pretty high.
Very attractive yield, yeah. Around 4.5% currently.
Now, sometimes a really high yield can be a red flag, like a yield trap. Is that the case here?
That's always the question to ask. But with AbbVie, it seems to be backed by, real earnings, strong cash flow. It doesn't look like they're just paying out money they don't have.
So it's legit. And even though they're younger than J&J, spun off in 2013, they've got their own impressive dividend track record going.
They really do. Since that spinoff, they've raised the dividend consistently, 52 hikes in about 10 years.
Wow, that's aggressive growth. Shows a real commitment to shareholders.
Absolutely. And their guidance, their forward-looking statements, they keep advising dividend growth as part of the plan.
So you get a nice yield now, plus the prospect of it growing. That's compelling for income investors. Now, that Allergan deal, though, it added a lot of debt, didn't it?
It did, yeah. A big chunk of debt came onto the balance sheet.
How are they handling that? Can they pay down debt and keep raising the dividend?
Seems like it. They generate a ton of free cash flow consistently, over $20 billion a year. That lets them aggressively pay down the debt while still funding the dividend and even buying back shares.
Buying back shares, another way to return value to investors over time.
Exactly. Compounds the returns.
Okay, so summing up AbbVie, a biopharma powerhouse, huge blockbuster drugs, even beyond Humira now, that juicy 4.5% yield.
Backed by strong cash flow and a management team very focused on results and shareholder returns.
Less maybe about potential, more about proven delivery.
Yeah, I think that's fair. While some biotechs are more speculative, AbbVie has a lot of established revenue streams already firing.
So for you, listener, maybe trying to navigate this sometimes confusing market, looking for reliable income without maybe like stomach churning risk.
Right. This is where these fortress dividend types could potentially fit in. Offer some stability when things feel uncertain.
Yeah, think of J&J and AbbVie as maybe providing some balance. They're probably not going to be the stocks that, shoot the lights out overnight.
Definitely not. Expectations need to be realistic.
But they offer that potential for consistent returns. Steady income over the long run, whether the market's up, down, or sideways. Inflation, Fed moves, pandemics. They've weathered storms.
It's about building that income foundation, not chasing quick wins.
Exactly. It's about that steady accumulation, collecting that cash, even when the market's having a tantrum. Maybe like that capitalist monk the source mentioned.
Perhaps. So key takeaways for you to remember.
Okay, for Johnson & Johnson, think Dividend King. Super strong finances, diverse healthcare businesses, decades of dividend hikes, reliability.
And for AbbVie, the biopharma beast, blockbuster drugs, that significant yield around 4.5%, strong cash generation, shareholder focus.
So we hope this deep dive gives you, some useful insights into two companies that could potentially add some stability, some income to your portfolio, help you ride out those market ups and downs.
Which really leads to a final thought or maybe a question for you to mull over.
Yeah.
How might adding companies like these with really resilient businesses, strong dividend track records, how might that change your perspective on market volatility, your comfort level? Maybe it's worth looking at your own holdings and thinking about their resilience. How well are they built to weather future storms?